Hello and welcome to the Business Expo Learning Stage. Thank you to our presenting sponsor, Blue Cross Blue Shield of Michigan, for helping make this event possible. We're excited to have you join us today and want to encourage you to ask any questions you may have. You may do so by using the Q&A button located on the right-hand side of your screen. All questions will be answered at the end of the webinar today. Also, a friendly reminder that this webinar will be recorded and posted to our Traverse Connect YouTube page within 24 hours. Our next speakers are Kim Schwaiger and Matt Grigsby from Rehmann. On their topic, 2020, in a year of uncertainty, taxes are still certain. Let's get planning. Kim is a principal with Rehmann's tax team, providing a variety of tax consulting services, as well as income tax planning and preparation services to individuals, corporations, and partnerships. As a trusted advisor to both medium and large size clients, Kim uses her deep technical knowledge to translate complex tax regulations into proactive ideas that help her clients succeed. As the need arises, she provides clients with direct access to Rehmann's broad range of tax and other consulting specialists. Kim is a member of the firm's real estate advisory team, working with industry specialists from around the firm to share best practices. She serves many clients in the construction, oil and gas, agribusiness, manufacturing, retail, and services industries. Since 1998, Matt has been providing tax consulting and compliance services to a broad range of clients with a focus on family-owned and closely held businesses and their owners. Matt has experience in federal and state taxation matters in the fields of real estate, construction, manufacturing, and retailing, as well as those of high net worth individuals. He is a member of the firm's real estate and construction industry groups. Matt is also responsible for the firm's cost recovery consulting services. He focuses on technical issues regarding property capitalization and depreciation, particularly as they relate to cost segregation studies. Matt has been a featured speaker for national webcasts on the topics of federal tax depreciation and federal energy-related tax incentives. Upon graduation from Walsh College, Matt received the Research Institute of America Graduate Tax Award for outstanding academic work and contribution to the college. Welcome, Kim and Matt.
Thank you, Jody. I'm going to kick it off today. We've kind of got our presentation divided into two sections. There were essentially two significant pieces of legislation passed this year that affect taxpayers. The first of which was the Families First Coronavirus Response Act, which was passed March 18th, and it established both the requirement to provide and a credit for paid sick leave and family leave for certain employers. And then there was also the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act. That was passed March 27th, and it established advanced tax credit stimulus checks, additional federal unemployment benefits of $600 per person, the employer retention tax credit, the payment protection program, and numerous other tax provisions. So the first thing I wanted to touch on is the Paycheck Protection Program. And this is one of the most important pieces of the CARES Act. And it established a low interest loan that was ultimately forgivable for taxpayers to use to pay payroll and benefits, mortgage interest, rents, and utilities. If the taxpayer spends the funds appropriately on those items I just mentioned, then they can get the loan forgiven. The PPP provisions that were passed expressly state that if the loan is forgiven, the forgiveness does not generate taxable income. And this is kind of unusual from the aspect that Code Section 108 has been around for a long time, and it generally says that if you do have a loan forgiven, the amount of the loan forgiveness is considered taxable income. So despite Congress's clear intent to not tax the forgiveness of the PPP loan funds, the IRS has kind of taken a different interpretation, and they've issued a notice indicating that when you're considering PPP loan forgiveness, you also have to look at Code Section 265, which generally provides that expenses related to non-taxable income are not deductible. So it is currently the service's position that all of the expenses paid for with PPP funds, including the payroll, benefits, mortgage interest, rents, and utilities, to the extent those the PPP loan is forgiven, those related expenses are not deductible, which effectively makes the forgiveness taxable. Now, again, this is not what Congress intended. Now, given the speed with which the CARES Act was passed, it's clear that Congress was not really aware of the interplay of Code Section 265 and how it might be applied by the IRS. So right now, there are bills out there to fix this problem essentially and make it clear that not only is the loan forgiveness itself not taxable, but the related expenses are deductible. But again, until Congress acts on that and passes a new law, this is Treasury's position, and taxpayers could be faced with essentially taxable income as a result of their PPP forgiveness. So this begs the question, what do taxpayers do if the forgiveness hasn't been granted before the year end? Or should taxpayers even apply for forgiveness before year end? Or what about if a loan is forgiven after year end, but before the taxpayer files their 2020 tax return? So there was an AICPA webcast last week, and it was stated that the IRS's position is that the deductions related to the PPP funds are not allowed as soon as there's a reasonable expectation of forgiveness. Now, what exactly that means and how some of these timing issues might play out are likely to be addressed very soon, and some guidance to be put out by the IRS. So the takeaway here is it's very important that you're aware of this potential taxation and that you talk with your CPA to make sure that you understand the impact of it, and particularly what that could mean to you in terms of underpayment penalties on estimated tax payments. So another thing that was dealt with under the CARES Act was the glitch in the law regarding qualified improvement property. So when the Tax Cuts and Jobs Act was passed in 2017, there were some big changes made to the tax depreciation rules. Previously, we've had bonus depreciation around since really 2001, and it's been in effect at various levels from 30 to 50 to now 100% of the cost of eligible property. So for any assets placed in service after September 27th of 2017, those assets that have a tax life of 20 years or less are eligible for 100% bonus. So this includes things like furniture, fixtures, and equipment, and land improvements. Now, the TCJA also created a new category of property called qualified improvement property. This was kind of a catch-all that kind of captured previous classifications of property like qualified leasehold improvements, qualified restaurant property, and qualified retail improvements. So qualified improvement property is now defined as the improvement to the interior portion of a building that's non-residential real property if such improvement was placed in service after the date the building was first placed in service. There are some exceptions though. QIP does not include building enlargements, elevators and escalators, and improvements to the internal structural framework of the building, like load-bearing walls, for example. And also, as I mentioned, QIP only applies to commercial property. It does not apply to not to residential property. When Congress passed the TCJA, it was intended that QIP would qualify for bonus depreciation. However, an error was made when the law was drafted, and they did not assign QIP a 15-year life. Instead, it was given a standard building life of 39 years. So the IRS said because it doesn't have a life of 20 years or less, it's not eligible for bonus. Thankfully, under the CARES Act, this problem was fixed because it retroactively assigned qualified improvement property a 15-year life. Now, the key word here is retroactively. Taxpayers now have to deal with the fact that they may have qualified improvement property that was placed in service after September 27 of 2017 that is now eligible for bonus, even if tax returns have already been filed for 17, 18, and even 19. So what we have is the opportunity to fix this, but we also have what's called a trap for the unwary because of the allowed or allowable rule. So when you sell an asset, your gain or loss is measured by the difference between the sales price and your adjusted basis in the asset. And depreciation deductions affect your adjusted basis. So your basis is reduced either by what's allowed, meaning what you took in depreciation deductions, or what's allowable, meaning what you should have taken. And now under this new rule, bonus is allowable on these qualified improvement property items. So if taxpayers don't fix this, then they could be stuck with a larger gain on the sale of the same asset, even though they didn't take depreciation deductions, nearly equal to what they would have had they taken bonus. So thankfully, the IRS has issued guidance here that allows flexibility to taxpayers in terms of how to correct the problem for previously placed in service equipment, or I should say qualified improvement property. The first way you can fix it is just by filing amended returns, or the easier way in often cases to fix it is to file an application for change in accounting method. And what you do there is you basically are allowed to take in the year that you file the form, a deduction equal to what you should have taken, which is 100% of the cost of the qualified improvement property, and what you actually took, which is 1 or 2/39ths of the amount of the cost of the improvement property. So there's two key ways to fix it, but they also took it a step further because there are elections that are made with regard to bonus depreciation, allowing you to elect out of bonus. And generally, you make those elections on a timely filed return, and once you make them, you can't change them. But because of this change in the law, they're now allowing taxpayers to go back and revisit their bonus depreciation elections and possibly elect out of bonus depreciation if they want to. So between the ability to file amended returns, the change in accounting method, and revisit the elections, it's critical that any taxpayer that might have qualified improvement property on their books that didn't take 100% bonus depreciation on it, they've got to review that with their CPA to make sure that they address this and get the deductions basically that they're entitled to. So another change under the CARES Act has to do with net operating losses. Now, the TCJA made some big changes to net operating losses starting in 2018. Generally in 2017 and prior years, you could either carry your losses back, a net operating loss, which again is the excess of deductible items over your gross income. So you have a tax loss. You could either carry that loss back 2 years or forward 20 years. However, the TCJA eliminated the ability to carry a loss back for losses starting in 2018, and it also imposed an 80% limitation on the use of NOLs, so that taxpayers can now deduct only 80% of their NOL against current year income, and this can catch taxpayers by surprise. So think, for example, you have a loss of $100,000 in year one and income of $100,000 in year two. Under the old rules, if you carry that $100,000 loss forward, you wouldn't pay any tax in year two because it would fully offset your income of $100,000 in year two. Now, though, under the TCJA, your year two income, you can only offset 80% of that. So you end up paying tax on $20,000. That's a relatively new provision. Thankfully, though, under the CARES Act, there were two key changes that were made. For losses incurred, NOLs incurred in 2018, 2019, and 2020, they're allowing now those losses to be carried back, not 2 years under the old rules, but 5 years. And also the 80% of taxable income limitation is suspended through the year 2020. So the 5-year carryback has two significant benefits. First, it provides taxpayers with more opportunity to fully utilize the NOL, obviously, because you can go back 5 years and you're not limited to the taxable income of just 2 years. But more importantly, it provides taxpayers the opportunity to recover even more tax dollars. Prior to 2018, the highest individual tax rate was 39.6% and the highest corporate tax rate was 35%. Starting in 2018, the highest individual tax rate is down to 37% and the corporate tax rate is a flat 21%. Plus, individuals now qualify for the 20% qualified business income deduction on flow-through income, like from partnerships and S-corps. And so it's possible that the highest federal tax rate is only 29.6%. So instead of carrying your loss forward into these new years with lower tax rates, you can actually carry that same loss back into a 5-year situation where the tax rates were higher, and you can save, if you're an individual, up to 10%. And if you're a corporation, up to 14% more in terms of your refund. So there's a lot of flexibility again with regard to these NOLs. And again, it's something you really want to take a look at if you have losses in 2018, 19, or 2020. So another aspect of the CARES Act is the employer payroll tax deferral. It now allows all employers, including self-employed individuals and partners who pay self-employment taxes, to defer the payment of the employer's share of FICA taxes. The payroll deferral period began on March 27th, 2020, and goes until December 31st of 2020. Half of the deferred amount is payable on December 31st of 2021, and the other half is payable on December 31st of 2022, and there are no interest charges with respect to these deferrals. It's important to note, though, that you still, as an employer, have to deposit your Medicare tax. This is only the FICA tax. And you also have to deposit all of the employees' taxes that are withheld. Employers who receive PPP funds are also eligible for this deferral, and there's no special election to make with regard to this. You simply report the amount being deferred on line 13B of the Form 941. Another element of the CARES Act that's important is the employee retention credit, which is designed to encourage employers to keep employees on the payroll, even if they're not working due to the effects of the coronavirus outbreak. The credit is equal to 50% of up to $10,000 of qualified wages, which includes amounts paid for health insurance, per full-time employee for all eligible calendar quarters beginning on March 13th and ending on December 31st of 2020. So this works out to a maximum credit of $5,000 per employee for the year. In order to qualify for the credit, you have to carry on a trade or business in 2020, and you must have either had to fully or partially suspend your business operations during the calendar quarter in 2020 due to orders from the government, or experience a significant decline in gross receipts during the calendar quarter, equal to less than 50% of the gross receipts in the same quarter in 2019. So for example, if you own a restaurant that's ordered closed to sit-down customers, but still allowed to continue carry out or drive-through or delivery options, that qualifies you for the credit because you've been ordered by the government to modify your operations. A significant decline in gross receipts test applies where your business was affected by COVID-19 or not, in fact. All you have to have is a decline from 2019. The qualified period begins in any quarter where receipts are less than 50% of the receipts in the same quarter in 2019, and it ends at the beginning of the first calendar quarter after the first quarter in which gross receipts are greater than 80% of the gross receipts for that quarter in 2019. So basically, let's say you hit below 50% in quarter number 2, even if you jump back up to 90% in quarter number 3, 90% of your 2019 gross receipts, you'll still qualify in that second trailing quarter. There are some key restrictions to the credit. The biggest one being if you applied for a PPP loan, you're not eligible to take the credit. There are certain other duplications that are not allowed, such as you can't claim the same wages on where you're claiming the family medical leave credit, or you can't include the same wages where employers take the work opportunity tax credit. And it's got to be, the amount of the credit must be included in taxable income. So $5,000 maximum per employee is taxable on your federal return. It's likely to be taxable on most of the state returns, but some states vary. And in terms of claiming the credit, it applies first against the employer portion of the 6.2% FICA tax, but any excess of that is refundable, and you can actually claim an advance credit on the Form 7200. So there's some miscellaneous provisions that the CARES Act addressed as well, again, benefiting taxpayers. The first deals with the changes with regard to the interest expense limitation. So prior to the Tax Cuts and Jobs Act, a business could generally deduct all of its business interest expense without any restriction. But the TCJA limited the annual net interest deduction to 30% of adjusted taxable income beginning in 2018 for certain large taxpayers, which is basically those with 25 million or more of gross receipts in 2018. 2019, it's those with 26 million or more of gross receipts. The net interest amount is the amount of interest paid or accrued by the business for the year, less the amount of interest income included in income for the year. For these purposes, the adjusted taxable income is calculated by starting with taxable income and excluding certain items like interest expense, interest income, and through 2022, depreciation and amortization expense. So you calculate the adjusted taxable income, multiply it by 30%, and that becomes the limitation on your deductible interest for the year. Any disallowed interest expense under these provisions is carried forward to the next year and is theoretically deductible in that year so long as you meet the criteria. What the CARES Act did was it raised the limit on business interest deductions from 30% to 50% of adjusted taxable income for the 2019 and 2020 calendar years. This can be, therefore, I should say, a business can amend its 2019 return if it already had filed and used the 30% limitation. And in addition to that, a nice perk is that a business can elect to calculate the 50% limit for 2020 based upon its adjusted taxable income for 2019. So you might end up with a bigger deduction if you have reduced taxable income in 2020 as compared to 2019. Another important change under the CARES Act is the suspension of the excess business loss limitation. Excess business losses come into play when a non-corporate taxpayer, like an individual or a trust or an estate, actively participates in a business that generates a loss. Particularly, it would be an S corporation or a partnership. Generally, these losses work to offset other taxable income, so wages, interest, dividends, cap gains, all of that. However, the TCJA limited the use of excess business losses to offset other items of income to only $250,000 for single individuals or $500,000 for married couples filing jointly. Any business losses beyond these limits were carried over to the subsequent year as a net operating loss. What the CARES Act did was it removed the excess business loss limitation for 2018, 2019, and 2020, effectively allowing taxpayers who are otherwise disallowed from utilizing all their business losses to do so. The overall intent here it was to allow taxpayers to either pay less tax upon filing 2019 or 2020 returns, or to allow refunds for losses incurred in 2018 without regard to the excess business loss limitation. It's important to note that for 2018, those taxpayers that rerun their returns without the business loss limitation applied, they can carry back that resulting net operating loss 5 years. So some things that aren't new but are worth a second look are the research and experimentation tax credit. This credit's been around for a long time, but it's become easier to claim in recent years, particularly because they've kind of laxed the documentation requirements for claiming the credit. Generally, there's a calculation involved, but the gist of it is, especially under the simplified method, you can claim a credit on your R&D expenses of up to 14% of the current year's qualifying expenses that exceed 50% of the prior 3 years average average expenses. And so this credit is not only available to companies that produce new or modified products, but it's also available to companies that create new or modified processes for the production of their products. So if a company shifts its manufacturing, let's say to produce items needed as a result of COVID, like hand sanitizer or PPE, the processes that are put in place to produce those products, the wages and some of the supplies and whatnot that generate the ability to produce those products, those can be used to claim the credit. Or if, let's say, a manufacturer changes the way in which it produces its goods, maybe it automates certain processes, maybe it rearranges its assembly processes because of social distancing, those modifications to the process in which they produce their goods can lead to an R&D credit. Another thing to consider is the work opportunity credit. A lot of companies are facing tremendous labor issues right now, and so they might be hiring people that they haven't hired in the past. These new employees that the companies hire might create eligibility for the work opportunity credit. That's a federal credit administered by the Department of Labor, and it's designed to entice employers to hire certain targeted populations. These include people on food stamps, veterans, ex-felons, disabled workers, and those receiving SSI benefits. The credit can generally be up to $2,400 per eligible employee per year, so it's worth looking into if you think you might qualify. It's currently, the credit is set to end at the end of 2020, but it's been extended in years past and may very well be extended into the future, so it's something to consider. And finally, there are abilities for taxpayers under the TCJA to modify their accounting methods, from switching from the accrual method to the cash method, to getting out of the onerous requirements for inventory accounting, to taxpayers who have long-term contracts like construction companies that would otherwise use the percentage of completion. They can switch to the completed contract method. And what that does is it can basically result in a permanent deferral of taxable income. So again, for those taxpayers that are maybe having a good year this year as a result of COVID, they should take a look at these accounting method changes, particularly if they have gross receipts of less than $25 million, to take advantage of them. And that is all I had. So with that, I'll turn it over to Kim.
Okay, thanks, Matt. I'm going to cover some tax credits that were made available under the Families First Coronavirus Response Act. As Matt mentioned, this was actually enacted prior to the CARES Act, but the news quickly shifted over to the bigger benefits of the CARES Act, including PPP. But now we're 7 months in, and this is getting a little more attention in our areas. We see a significant uptick in some of our COVID cases. I think that Grand Traverse County over the last week had 177 new cases, and the positivity rate is creeping up to that 10% threshold where schools may consider going remote. So the intent of this program is to allow individuals impacted by COVID to stay at home and still receive a paycheck. And the government is reimbursing employers for paying that via dollar for dollar credit. So there are two categories of paid leave that are covered by this act. The first and more all-encompassing is the sick leave. This applies to all private employers with less than 500 employees. And it also is required to be paid to all employees, whether they be full-time, part-time. You could have hired them last week and you're still required to pay them this paid leave if they qualify. The only real exclusion is for employees that are considered healthcare providers. So when does this come into play? We've got 6 conditions listed here that if an employee is dealing with, they may be eligible for the paid sick leave. The government isolation order, quarantining under the advice of a healthcare provider for COVID-19, or because they may have a condition that makes them extremely vulnerable to COVID-19. Someone that's experiencing symptoms and waiting for a test, I think locally that can be up to a 5-day wait time. They could be caring for a family member or someone that normally resides in their home that's quarantining for one of these reasons, or caring for a child because of the closure of the child's school or child care facility. And this is becoming a big one. I think Matt and I were talking, we both have kids home that have been home yesterday and today because of the school closures. The 6th category is just a placeholder. DHHS has not yet specified what might fall into that, so we can ignore that for now. So if you've got an employee with one of these 6 conditions, that isn't quite enough. It must also prevent the employee from working or teleworking. So let's just say I'm a company bookkeeper. My child's school is closed. I can access the software from home. Okay, I can wake up early, do some of my work, do the work after my school day's over, helping my kid on Zoom. I would be eligible for this. But let's say instead, I'm a single mom, I work on an assembly line, my child's school is closed and I don't have anybody else to watch the child, I would be eligible. So, you just have to work through the different scenarios with your employees to see when they can or cannot work or telework from home. So this first category of sick leave is going to cover 2 weeks of pay. So full-time folks are going to get up to 80 hours of pay. Part-time folks are going to get what they would typically average in a given week over a 2-week period. We've got 2 levels of pay. So it's the way I like to view this is broken up between if you're home because of a reason regarding your own case of COVID or your own quarantine order, you're going to be eligible to receive regular pay, and that's capped at $511 per day. An employee can choose to pay more than that, but the credits are capped at the $511 per day or regular pay. What that equates out to is about $132,000 salary range. So if somebody's over that, they're going to be capped at $511 per day. If instead you're home to care for somebody in your family, you're going to be at this 2/3 pay rate. And that's capped at $200 per day. And what that equates to is about a $78,000 annual salary. The second bucket of leave is paid family leave. Again, this applies to employers with less than 500 employees. There is a limited exemption just for this category of pay for folks with less than 50 employees. And to claim this, an officer of the company would need to document basically why providing the pay would jeopardize the business as a going concern. So there are kind of three reasons. One, the business just monetarily can't afford to pay the leave prior to receiving the credit. The second would be that the employee requesting the leave is, so vital to the company's operations that you can't be without them. The third would be that the business wouldn't be able to operate if employees were on leave, meaning you just couldn't find replacement employees. Okay, there's also this 30-day minimum employment period before an employee is eligible for this, and that differs from the paid sick leave. This is not going to cover all of the 6 previous conditions. This is only for when you're home caring for a child because of the closure of the school or childcare. Okay, so this offers another 10 weeks of qualifying paid leave for these folks on top of the original 2 weeks of sick leave. And we were at the same pay structure as the sick leave, 2/3 regular pay up to $200 a day. Okay, so we've covered who's required to pay this and who's eligible. Now what we want to get into is just how to calculate it and how to claim it. The credit's going to be equal to not only the qualified wage amounts that we just went through, but also the allocable health plan expenses related to those wages. So their portion of health insurance that you're paying, plus the employer's share of Medicare tax on those wages. Okay, and the reason it's just Medicare tax is that those wages are not subject to Social Security from the employer. The expected credit, you can short your 941 deposits by the amount of your expected credit. If you think that it's going to exceed your 941 deposits, you can claim an advance credit on Form 7200. Okay, one thing to keep in mind, you'll see like some of these other provisions, this right now is set to expire December 31st, 2020. So that's another month and a half. I think everyone's expecting that we could still be dealing with these COVID cases well beyond that. So we don't know if it'll be extended, but one thing to note is when the bill was first passed, it did have quite broad bipartisan support, which is a rare thing these days. It was 363 to 40 in the House and a vote of 90 to 8 in the Senate. So that does bode well for potentially an extension. Okay, just quickly on the documentation side, you are going to want to have documentation as an employer for the employees that are requesting the leave. It should include their name, dates of the leave, the qualifying reason. It should also list the healthcare provider. If their leave is for quarantine under the advice of a healthcare provider, it does need to list that name. A statement that they're unable to work or telework. If it's for the child being home, you also need to have some additional information, name of child, name of school, etc. Okay, and if the child's older than 14, just keep in mind that you do need to document the special circumstances for why you need to be home. you're going to want to hold on to those documents for 4 years, as well as the calculation of the dollar amount of the credit. This slide here is just a nice summary. There's a lot of stuff we've been talking through. It's hard to keep track of it all. This slide focuses on a comparison of, both the credits that I've talked about, as well as a couple of the provisions that Matt mentioned under the CARES Act. And what I really want to focus on here is just, the interaction of these provisions. This payroll protection loan restriction says none for paid sick leave and none for paid family leave. That is true. So if you get a PPP, you can also take advantage of these, but you cannot double dip. So just keep that in mind. If you're claiming the paid sick leave or paid family leave credit, you can't also use that for forgiveness of your PPP loan. So I think we've overwhelmed you guys with all of the tax provisions that were passed as part of coronavirus tax relief. Now we just want to briefly look into the future a bit, into 2021 and beyond. The question I think on a lot of our minds in the tax world was, which administration we were going to be dealing with. As of Saturday, I think, with reasonable certainty, we're looking at a Biden-Harris White House come 2021. So let's just review quickly the significant tax proposals of that ticket. They're, as you can expect, geared towards increasing the taxes on the wealthy, and some pretty significant tax increases were proposed. So we've got the elimination of favorable capital gains rates for people earning over $1 million. Currently, those are capped at, can be 15%, 20%. Those would go up to the ordinary income rates for people over $1 million under Biden's proposal. We would also see an elimination, if his proposal got through, of Trump tax cuts, so the TCJA tax cuts in late 2017 would be eliminated for those making over $400,000. Estate tax changes, this one was getting a lot of attention because the change is quite significant. So currently there's an $11.58 million lifetime exclusion, meaning someone can pass on wealth during their life of $11.58 million through gifts or when they pass. Biden was suggesting that that come down to $3.5 million per person, so that's a significant change. And there's also an elimination proposed of the step up that's currently available upon death. So right now, if I die and I pass on $11 million of Ford stock that I bought for a penny, my heirs can sell that and not pay any tax, and my estate also doesn't pay any tax. So that was going to be eliminated under the Biden proposal. C corporation tax rates, we were going to see a proposed increase here. Remember, these were up at the 34-35% rates, a marginal rate system that fell down to a 21% flat rate in 2018. Biden wanted to see that go up to 28%. There were some additional provisions related to motivating folks to move manufacturing here into the US and charging a surtax if it was done offshore. But overall, I think I read one article that called this Tax-mageddon, for the scenario that all of this would get passed and it would be retroactive to 2021. But it's looking like we still don't have a final answer on that, but we're waiting for a runoff in Georgia for 2 Senate seats, but it's looking likely that we're going to have a split Congress. So House is going to be Democratic controlled, Senate Republican controlled. And so what that means is really that all of these proposals are going to have a hard time making their way through Congress. One thing I will point out is that the Congressional Budget Office right now projects a federal budget deficit of $3.3 trillion in 2020. That's the largest it's been since 1946, and that weighs on the side of tax increases, but we really don't know where this is going to land. So even without implementation of those proposals, we just want to remind everybody of these sunsetting provisions. So these were introduced with the Trump tax cuts, but they had an expiration date. So we want to go through those quickly. The qualified business income deduction, which I think Matt mentioned, is expiring in 2025. Bonus is starting to step down in 2022. All of the reduced individual income tax brackets and rates, 23 provisions and all, are going away in 2025. And the estate tax exemption will fall in half in 2025. So what that means is even without significant tax proposals getting through, tax increases, as we near these expiration dates, we just want to be aware of the typical tax deferral strategy that we often suggest is to postpone paying taxes as long as you can. With all else equal and rates the same, that's a normal strategy that works. And what I mean by that, by a tax deferral, would be installment sales, traditional IRA, prepaying expenses, taking all this bonus depreciation, accelerated. Those things may become something you want to just take a second look at as we look at the potential of increased rates. Okay, this next slide too, we've talked about federal changes quite a bit, but what you'll see on this slide here is the difference in revenue that the states have collected from fiscal year 2019 to fiscal year 20. So Michigan, we're showing a 6.6% less revenue. Likely fiscal year 21, maybe something similar. All the states in red have had a decrease in their revenue. So as you know, Michigan is required to balance their budget. That's the case in most all the other states too. So, what we can project is likely state tax increases. We just want to cover two trends quickly that we've been seeing. Apportioning federal income to the states based on a ratio of sales rather than physical presence. The second is movement towards gross receipts taxes, and these are viewed as recession-proof since they aren't based on income. Oregon was the most recent state to introduce that, adding to Ohio, Washington, Texas. Okay, so we may see more of that on the horizon. What we suggest for people to be wary of is just that states are casting wider nets, and even though your physical presence is only in Michigan, you just want to get out of that mindset that Michigan is the only state you need to worry about. So I found this based on a conversation Matt and I had the other night, this cartoon. So, it can be ominous to hear about all these tax increases on the horizon or potential for them, but we hope that we've provided some more sound tax planning tools than Homer Simpson's last minute strategy.
That's great, Kim.
Yeah, and with that, we've I think only got a few minutes for questions, but we'll open it up for the first question.
Yeah, so we just had just a few come in. I gave one to Matt in chat as you were talking. With the work opportunity credit, there was a question, how does that work? Is that what's the amount of that? Is it a percentage? What is that?
So like everything Congress passes, nothing is simple, but basically if you employ someone in one of those targeted groups up to 120 hours, you don't get a credit. If you employ them 120 to 400 hours, your maximum credit is 25% of the wages paid. And if you employ somebody for more than 400 hours, it's capped, or it's eligible for a 40% credit. However, there are wage limitations in there, which generally cap out at $6,000. So that's why in my example, I said a maximum of 2,400. It would be the $6,000 wage cap times a 40% credit is your $2,400.
Okay, that's great. Thank you for going over that. Another question we had was, you can ask for, let's see, for sick leave pay, does this apply if the employee has regular sick time left to use, or is this separate from the company administered paid sick time?
Yeah, I'd want to double check, but I do not think you can require the employee to take their normal sick pay before offering this.
Okay.
But
okay.
we can double check if there's a particular individual's name or contact info.
Okay, that's great. Yeah, we can follow up with you on that. And this one was more about personal taxes, I believe. How will stimulus checks that folks received this year affect their taxes in 2021?
So the
In
checks
2020.
themselves shouldn't have any impact in that even if your AGI changed and you theoretically got more than you should have, I believe there's no impact to that fact, and it shouldn't result in anything owed or anything refunded. The only way people on their tax returns are going to be impacted is if for some reason they did not receive a stimulus check, then they can claim this refundable credit on their income tax returns.
Okay, great. Thank you for that clarification. So I think that's it. I don't see any other questions. I want to thank you both again, Kim and Matt, for joining us today. We greatly appreciate your time and sharing your valuable information. We'd also like to thank once again Blue Cross Blue Shield of Michigan for making this event possible. We hope all of you who attended enjoyed the learning stage and encourage you to check out future learning stage webinars. We still have 2 more coming up this afternoon in just a short while. The next one will start at 3 o'clock. And also check out our features in our virtual expo today. Thank you all for attending. Stay safe, stay healthy, and we hope to see you at our next webinar. Thanks again, Kim and Matt.
Thank you.
Thank you.